Hello everyone, I am Priya, Assistant Professor, Department of Commerce, St.Josephs College of Arts and Science for Women, Hosur. In this video, I am here to present the ratio analysis. Analysis and interpretations of financial statements with the help of ratios is termed as a ratio analysis. Ratio analysis involves the process of the computing, determining, and presenting the relationship of items of groups of items, financial statements. Ratio analysis was pioneered by Alexander Wall, who presented a system of ratio analysis in the year 1909. Alexander's contention was that the interpretations of financial statements can be made easier by establishing quantitative relationship between various items of financial statements. The meaning of ratio and ratio analysis. The ratio is the mathematical relationship between two items expressed in a quantitative form. Ratio can be defined as relationships expressed in quantitative terms between figures which have cause and effect relationships or which are connected with each other in some manner or the other. An accounting ratio can be defined as quantitative relationship between two or more items of the financial statements connected with each other. Arithmetically, ratio is a comparison of the numerator with the denominator. The advantages of the ratio: forecasting and managerial control, facilitates communications, measuring the efficiency, facilitating investment decisions, useful in measuring financial solvency, interfirm comparisons. The limitations of ratio analysis: practical knowledge, ratios or means, the interrelationships, non-availability of standards or norms, accuracy of financial informations, consistency in preparations of financial statements. Detachment from financial statement and time lag, change in price level. Modes of expression of ratios. In proportions, the amount of two types are expressed in a common denominator. An example of this expressions is the relationship between current assets and current liabilities. In coefficient, that quotations obtained by dividing one item by another is taken as unit. The steps in ratio analysis for selection of relevant informations and the comparisons of the calculated ratios, interpretations, and we have to give the reporting. Classifications of the ratios. Classifications of the ratios by statements and classifications by uses and classifications by relative importance. The classifications by the statements. It's regarding for that according ratios can be classified in a number of ways. Important among them are stated below. For the classifications according to statement, for the profit and loss account ratios calculated on the basis of the items of the profit and loss account only. Example: gross profit ratio, expenses ratio, net profit ratio, etc. Balance sheet ratios. This ratios is calculated on the basis of figures of the balance sheet only. Example: the current ratio, quick ratio, proprietary ratio, etc. The composite ratios. These ratios is based on figures or profit and loss account as well as the balance sheet. Example: debtors and creditors turnover ratio, return on capital employed, etc. Classifications according to the functions. It's a solvency ratios, short-term and long-term solvency ratios. Example: current ratio, debt equity ratio. Profitability ratios. Example: gross profit ratio, net profit ratio, operating profit ratio, return on capital employed. Turnover or activity ratios. Example: stock turnover ratio, debtors turnover ratio, creditors turnover ratio. And the final is the ratio is a capital structure ratio. Example: capital gearing ratio. The classifications by uses for the relating to the ratios for management and ratios for creditors and ratios for the shareholders. The ratios for management is like operating ratio, stock turnover ratio, and debt equity ratio. Ratios for the creditors like solvency ratios, interest coverage ratios, and assets coverage ratios. Ratios for shareholders like shareholders funds, capital gearing, and payout ratios. Classifications by relative importance is like primary ratios and secondary performance ratios, secondary credit ratios, and a growth ratio, liquid ratio, and the current ratios. Thank you.